Hi, this is Pat with Energy Solution Partners sharing with you our energy market view on Labor Day, September 1st. As always, keep in mind there is a risk of loss when trading commodity futures and options. Well, I'm going to take the time today and focus a little more on crude oil and kind of some bigger picture items going on with some market structure. Although most of the time our focus is on the refined products, and that's the business most of us are in. I have seen a shift on some things going on in the crude market that I think is worth noting. But before I get into that, I will just comment briefly on the refined products. And the market has been pretty well supplied between supply and demand. But that being the case, we've been able to keep the supply going with refineries running in excess of 90% capacity. And as long as this continues, it looks like this supply demand will be pretty well balanced. But we are at risk if there's a hiccup or two in the refining sector that could shift suddenly. We'll start out today taking a look at a weekly WTI crude chart. And what I'm focusing on this weekly chart is going to be the stochastics. And as we look down here at the stochastic study, we are in an oversold condition. As this market has sold off over the past couple months here, we have moved into an oversold condition, and I think that is ripe for some sort of pop in this market here, and I'm probably expecting that here in the short term, a little bit of pop in the market. But saying that, the long-term prospects I don't think are that promising, and we'll get into some of that market structure here shortly. But just going back, looking at some previous times we've been in this oversold condition from the stochastics measurement, look what's happened with the market. We generally tend to rally, and as we move into these oversold conditions, that's money sitting on the sidelines just waiting to come to work, and whatever that catalyst is to come back into the market, we are sitting down in that area right now. So keep in mind we are in a very oversold condition, ripe for probably a little rally here in the short term. If we look at what the crude market has done here, and the blue line is the Brent contract, and the white line is the WTI contract, and overall it's the same pattern here. And since the 1st of July, we've seen both of these crude markets drop about $10 a barrel. Now, if we take a look at what the forward curve market has done, first of all here in WTI, and this red line is what the forward curve looked like 2 months ago. And you can see it's a backwardated forward curve. What that means, the front month was fetching a much higher price than what it was 12 months out. And when you see that type of market structure, that's telling you demand is pretty strong, and the market's willing to pay up more in the front month to get delivery, and it's not paying you to store those barrels for later delivery. Now this white line is the same WTI today, so you can see how that market structure has changed a little bit, and this white line has flattened out a little bit more from what it looked like 2 months ago. And it is still in a slightly backwardated market, where it's still paying a little more in the front of the curve than it is in the outer month, but it's definitely flattened out. So it's showing us that the market structure has changed here as we watch this forward curve flatten out. Now if we go to the Brent crude, I think this really paints a picture here of what this forward curve has done. Again, going back 2 months, you can see the shape of that forward curve. Still paying more in the front months than it is in the outer months, telling you demand was pretty heavy 2 months ago. But now let's look at this forward curve today, and now it's turned into a carry market. And the lowest price is on the front end of the curve, telling you the demand isn't here. When you see this type of market structure, it's telling you that the market will pay you to store barrels out here because the outer months are higher price than what the front month is. And this is telling you that demand just is not that strong. So when we see this type of carry structure on that curve, that's usually a pretty bearish sign for the fundamentals. Now if we take a look at the crude oil inventory levels at the Cushing, Oklahoma hub, and while this hub is not huge in storage, it is huge in the meaning of the market, as this is a delivery point for WTI crude. Look what's happened to the inventory levels at this hub since the first of the year. And we've really drawn these inventories down as there's been new pipeline capacity shipping crude oil to the south. At one time we had a huge glut here in Cushing. Now with the reversal of some pipelines and some newly built pipelines open, we've really drained this hub. So as we've watched these inventories draw down here in the first half of the year, it really tells a story where we've seen crude oil pricing in the middle part of the year is U.S. as a whole was seeing record inventory in crude oil back in April, and the market just kept climbing higher. And I think the pricing was all focused on this Cushing delivery point, and as we continued to draw these stocks down, we continued to push crude prices higher. But what I find interesting now over the last 4 or 5 weeks of inventory reports, now this is reversed, and we've actually started to build some inventories back up here, and so we've really drawn this hub down sharply. At the same time, we've watched the Gulf Coast inventories of crude oil build, and I think we came close to peaking in capacity down in the Gulf Coast, and now all of a sudden that crude oil starting to back up again into this Cushing hub. So we'll want to keep an eye on that moving forward, and if we see these stock builds continue at Cushing, I think that's going to be very negative for crude prices going forward. If we look at overall U.S. crude stocks, you can see we've been running right at the top of the 5-year average, and we have been in the typical drawdown. If we look at the 5-year average, stocks from March to this point have typically drawn down, and now moving forward, it's typical now that we build these stocks back up. So again, we'll be watching these U.S. crude stocks here into the next several weeks and see if we watch the stock build continue, and again, more so focusing in that Cushing area. So with these thoughts in mind, we'll continue to watch the upcoming inventory reports, gauge which direction these crude stocks are going, both the Cushing hub and overall U.S. Inventories of crude oil. But for the most part, we're going to be pretty defensive at this point. Not real eager to be jumping in buying contracts, especially out into the next spring time frame. If you do have any open positions or looking to get some price protection in place for downside coverage, I think that's probably a pretty good idea moving forward. If you want to discuss the market any further, feel free to give us a call. We'd love to visit with you. Thanks, and have a great day.